All right. With that out of the way, let's hit this. Perfect. All right. So today we're going to be talking about projections and how you make them accurately in your business and how to not make them in your business. And Scott Reynolds, you had mentioned that you were making projections. We went through some of this with your business, and I want to extrapolate this out to everyone and look at how do we accurately make a projection? What's the data that I need? And how should I be thinking about this for my business type? So as we've worked with a number of different businesses, I think there's really two different types of models that we would fall under, or types of revenue that we would be projecting out. Now, your business might have one or both of these. And in that case, we might have to look at each of those sides of the business a little bit differently. But there's two fundamental different sides. There's the recurring revenue side, where we make a sale once and that sale keeps benefiting us over and over and over. Okay, it's recurring revenue. We'll look at which models that impacts. And then there's what I'll just call single sale models. And you and your business fall into one of these models. So let's look at these. So within the recurring revenue side of things, there's a couple of different models. There's the subscription model, where, if you run a software company, it's really easy to see how that subscription might work. If you run an insurance company, it's easy to see how that would work. If you run a property management company, right, it's a subscription. Sometimes it's more of a retainer model. If you're in a consulting type of role and you're doing a retainer, that's the recurring revenue. So it's not just saying that, yes, these people buy from me multiple times. It's that we have an agreement set up that someone will pay us on a recurring basis for some period of time, whether it's indefinite, month to month, for 12 months, whatever it is. We have some kind of recurring revenue that we can count on because someone has agreed to paying us that. So examples of these businesses, it might be a marketing agency, right? Oops. We've got some podcasters in here. We got Nate, right, who runs a podcasting agency. We have a number of other marketing agencies actually coming on right now. And so that's one. Insurance providers, we talked about that. If you're in the healthcare space, then it might be that you have a wellness model, right? It's like, oh yeah, they're on the wellness plan. So they're coming in every month for their sort of check-in or checkup. In the trucking side, because I was thinking about you, Dan, if you're still on here, there may be some recurring revenue where you have, predetermined loads that you're going to take every week. And we just know that money is going to be there because we've got the contract for it. And on the property management side, pretty straightforward. And then even something like bookkeeping, right? It's a very much recurring revenue type of model. There are others within that fit, but you can look at your business and say, do I have a recurring model or not? Then on the other side, we've got what I'll just call single sale. And the model here is you may even still have repeat buyers. They may be buying from you regularly, but there's not an assumption that they're going to keep buying at the same revenue amount, right? Every single week or every month or every quarter. So they may be repeat buyers, but it's not on a regular cadence at a regular price. Okay. So we wouldn't call that recurring revenue necessarily. You might even have a business where you have a payment plan, right? So our business technically falls into this single sale, a little bit of recurring too, but technically a payment plan would still be a single sale because it's a one-time purchase that they've just stretched out over a period of time. And then the other one would be where a lot of you fall into, which is just one-off buyers, or even if they're one-off buyers that do buy sporadically, right? So examples here on the trucking side, I needed to put this in here. Maybe we have a single load, right? Or they have a load that this week I don't even know how the tonnage works, Dan, but let's say we've got a 5-ton load this week. Next week, we have a 2-ton load. The next one, we have a 10-ton load. I don't know, right? But it's sporadic, not recurring types of loads. An electrician, right? We've got Court in here who runs an electrical business. They're going to be single sale. Maybe you run a consultancy online that is a one-time purchase kind of thing. And then I would just say most service providers end up falling into this single sale type model where we're not doing recurring revenue. I would say maybe even, and I was trying to think about what does a dental practice fall under? And, they do have a recurring model where it's like, hey, let's see you in the next 6 months, right? And we get on there. Maybe there's even more frequent, checkups or cleanings or something. But I'm still undecided as to whether I would say that that is a full recurring revenue model or more of a sporadic single sale. I'm not sure. We'll look at things today. And then Sahir, I'm curious how you feel like after we look at some examples below of how you would put that in under which model. So when we're figuring out what our projection is going to look like, we just have to look at first, what type of revenue do I have? Okay. Because if we have a recurring revenue type model, it's a lot easier to make projections, right? If we have anything that is not recurring revenue, anything over here, there's a little bit more nuance to this, right? And we have to be a little bit more careful with how we make projections. And so I see a lot of businesses that are in this single sale side of things that say, oh, we're projected to do this much this year. It's like, how, right? How? So let's talk about the how. But I would love to know before that, do you feel like right now, just with that quick explanation, I want you to type into the chat right now. So if you're driving, keep your hands on the darn wheel. But if you're not, I want you to just type in the chat either 1 or 2. If you're a recurring revenue type of business primarily, then you would put a 1. If you're single sale, put 2. Or if you have both, then put both. I'm just curious which one you think you are based off what we just said. 1, 2, or a mix of both. And I got to find our chat here so I can pull it up. All right, so we got some both coming in. And I would expect that many of you fall into both. Okay, we got some single sale. Yep, 2, but need more 1. Yes, I agree, Stacy. That's great. And by the way, Stacy, you and Sarah actually have fairly similar business models, separate healthcare industries, but similar models. So here's how we're going to walk through this from a projections standpoint. I want to look at the variables that we have to look at within each of these domains. And on the recurring revenue side, they have some specific ones. On the single sales side, there's some specific ones. But there's a lot of shared variables that we're going to look at here as you're making projections. And so on the recurring revenue side here, so our variables, the biggest variable is what we call churn, which is how quickly do people drop off of the recurring revenue cycle. So if I were a marketing agency, for example, let's say I sign up people, maybe I build websites. We got a website client I was just talking with yesterday, and we were looking at their client base and their churn rate. And so churn is defined as over a certain period of time, whether it's looking at per month or per year, how frequently does someone drop off, or what percentage of your clients drop off over that period of time? And so the calculation here, there's 2 ways to do it. This is I feel like the most straightforward, just doing a percentage calculation. And so you need to look at over one period of time, and it's easiest to look backwards, right? It's hard to project churn, but it's really defined when we look backwards. So I like to look at over a period of 1 year, and it depends on the life cycle of your business and how long you serve people, really. But a year will often encapsulate an entire sort of period of serving a client. So we want to look at over the period of a year. Let's say that, right now we're pretty early on in 2023. So we might look at 2022. So you would look at your numbers in 2022 at the very beginning of the year. How many clients did you have at the beginning of the year? Let's say it was 100. And then we're going to track just those clients and see how many of those clients fell off or stopped being clients by the end of the year. And let's say we lost 25 of them, right? So we lost 25%. So we're going to have we'll do a quick look at this. And I know many of you here aren't in the churn category. However, if you are, this is a really misunderstood thing. People don't know how to calculate it. So watch this for just a minute. So let's say we had 100 total customers and we lost 25. So we have 25 divided by 100 divided by 12, because here I'm getting a monthly number. If I want to see monthly, what's my churn rate? So 25 over 100 gives me 25 over 100 gives me my 0.25. I divide that by 12, and then I multiply by 100 to give me a percentage. That's 2.08%. Okay. So I divide it by 12, and then I multiply by 100. Okay. So in this case, my monthly churn would be 2.1%, we'll call it. My yearly churn is 25%, right? And so now I can have a good say in, if I do no new marketing and I don't change anything about my program based off or my delivery based off last year, how many clients do I expect to have at the end of this year? And let's say now I have 200 clients. Well, I would expect if my churn rate is 25%, Out of those 200, I'll lose 50 of them, right? And so each month, then I can extrapolate that out and see, okay, each month, if I've got 200 clients and I lose 2% of them a month, 200 times 2% is going to be 4 clients. So I'm going to expect that I'm losing 4 clients every month. And so when I'm making projections, it's really important that I don't just factor in how many new clients I'm getting, but how frequently are clients dropping off, because I have to factor that in. Okay. Any questions on churn? I know we don't have a lot of people in this scenario right here on the call. If you are in a boat where churn is a thing for you, it's one of the most important numbers to track in your business, because it literally determines how much you'll make and how much you can spend on advertising and everything. It's really important number for those businesses. No questions here, I would guess. Cool. The second piece here is upsell rate or upgrade rate. If you have someone that is on a recurring, let's say that website agency, right? You build them a website and then you're doing monthly sort of recurring maintenance on that website. And all of a sudden you add in SEO services. Well, what percentage of people upgrade from just, everyday website management? What percentage upgrade to SEO? So it would be important to know that, because your projections will be based off that, right? If I have a 10% upgrade rate, then I know that if I bring in 10 new clients, not only will they stay for a certain amount of time, but I will also upgrade an extra one of those to my SEO on average. And so just knowing those numbers factors into the projections, because we've got to figure out who's dropping off and who's staying with us and ascending to our next offers. I'm sure there's others here, and we can talk through them. If you think of one where you're like, hey, Alex, what about this? We can totally add it here. But those are the recurring revenue specific numbers that we need to know. Okay. Now let's talk single sale variables here for a minute. And I am sure that there's some more here, but this is the very first one that comes to mind that is pretty big. And then we'll look at the shared ones here. So single sale variables, biggest one I would just say is lifetime value of a client. And Scott mentioned this when he was talking about the numbers that he talked to his investor about. What does a new buyer bring in on average over a given period of time? So we might call it the first 12 months. We might say, how much does a new client bring on average in 12 months? And so when looking at Scott's business, for example, so Scott does pool repair and maintenance. So it's like, all right, well, someone comes in and they buy, let's call it a pool cleaning, right? And maybe a repair. It's like, well, they might spend $500 on the repair, but that's not the lifetime value of a client, because some of them will also join the maintenance side of things and keep going with a monthly maintenance or cleaning program, right? And so when we looked at it from that perspective, Scott's lifetime value of a customer was a lot more than, and I'm just pulling numbers out of the air here, but a lot more than maybe that $500 of the very first thing they buy, right? And so when we looked at Scott, it went up significantly when we looked at your average lifetime value. And we have to factor that in. What are the other things that they will often buy, right? So Sarah, for you, this is really important, right? Because someone's going to come in, they might buy one thing first, and then that they upsell to other things. And we can figure out on average, how much does the normal person buy from me? And in order to do that, the easiest way is to look at, over, let's call it a year, how many clients did I have? How many individual clients did I have? Let's say I had 100 clients. And those 100 clients brought me, let's call it 300,000 of revenue. Okay, well, 300,000 divided by the 100 would give me my, math, $3,000. I shouldn't need a calculator for that one. So my average lifetime value or 1 year value of a client would be $3,000 in that case, right? So even though I might have one service, my normal package is $2,000. Well, some people are upselling to the other stuff and they're continuing on with maintenance. So they're really worth, $3,000 to me. Okay. So we get our lifetime value of clients. Now, this is true on the recurring revenue side as well. And we get to lifetime value by understanding churn. And so this is why I put these two separately. Lifetime value is still really important on the recurring revenue side. We just have to factor in churn to get to there. So let's take the shared variables for a minute. Then we'll look at actually doing out our projections here. So a couple of shared variables here. The biggest one is seasonality for a lot of businesses, right? You might have a business that looks like this. So if we're looking at different months of the year, January, February, March, April, May, June, July, right on through the year, your revenue might look like this. It might start lowish in the wintry months, and then March and April, as it starts getting warmer, we're peaking up, and we peak up somewhere in summer, and then it drops off hard once people start school, right? Might look like that, might look different. However yours looks, it's important to recognize that there are seasonal cycles to your business. Sometimes the cycle might not be yearly. So for example, if I were in a political consultancy, my cycles would follow the political election cycle, right? And it might be a 2-year cycle or a 4-year cycle. And so it's just good to figure out what is the cycle, the seasonality within your business. And for a lot of businesses, that follows the calendar here, right? The reason that this is important is I might have started my business here in February. Whoops. Maybe I started the business here in February. And right now I am assessing my projections for next year, but it's only August. I might take this growth rate and say, I'm killing it. I'm up 10,000%. Well, how much of that is just seasonality versus the business is actually growing, getting new customers, or is it just a seasonal effect? And so it's really hard to make projections before going through a full cycle of a year in a yearly cycled business. So this is why it's really nice to get every month's data. And this is why we put every month's data on your monthly dashboard, right? This is why we have a January, a February, a March, so that we can start seeing what is the trend, not just in revenue, but maybe in expenses. We have some businesses where all their revenue comes in during the first half of the year and all their expenses go out the second half. Do you think it would be important to know that so that we can plan and project? Absolutely, right? So this is a know thy business moment, right? I think all of us can identify the seasonality in our business to a degree. And if you can't, then I would go back and look at month to month, historically, what's happened. And you might see that, there's a big drop off in December. Well, the question is that drop off because of your customers or is that drop off because of you? I don't know. Maybe you take off 3 weeks in December and so it drops. Fine. We just got to understand that, right? And so understanding seasonality is first here on both sides. Next, this is exactly what Scott was talking about, looking at growth rates. Growth rate is a little bit deceptive because it is a conglomeration of all the things that you've been doing, plus it factors in some seasonality, right? And so if I have a yearly seasonal business, then I want to look at my growth rate year over year, right? Or January to January. Like, what does this January look like versus last January, right? That way I can take out the seasonal variables. Here's the problem. The world came to a grinding halt in about March of 2020, and all of these seasonal projections totally fell off and the data went totally crazy for in-person businesses. In fact, for many businesses. And so as we compare numbers and I'm sitting down with you and I'm saying, let's come up with some projections, I will probably not include anything from 2020 because it was totally crazy and a complete anomaly, right? And so we got to use good data if we're going to make projections. Otherwise, garbage in, garbage out. And we can't trust any of the numbers if we have bad inputs. And so I will often just say, okay, well, if we have a seasonal business, especially if you have a brick and mortar that was affected heavily by COVID, or maybe a non-brick and mortar and your sales skyrocketed during 2020 and 2021, and then came back to earth a little bit last year, well, then we're probably not going to look at the anomaly years, right? And we're going to look at what trend were we on in relatively normal years leading up to it? What trend were we on maybe last year? And, there might be some bigger economic things that are happening now that might affect your business. So we need to factor all that in. But just looking at growth rate, it might be easy to see that, on average, I'm growing at 20%. From 2018 to 2019, if I look at my total yearly revenue, maybe I'm 20% here. Maybe from 19 to 20, I was 22%. 20 to 21, maybe I exploded and we grew by 80% here. But then we contracted and, the demand slowed down and maybe I dropped some, or maybe it wasn't quite as steep. And maybe I was only at, maybe I was break even or close to it in terms of growth. And then maybe from 2022 to 2023, I'm back at like 18%. Okay, well, I might look at that and say, my growth rate's all over the place and every year's a little bit different. But we can say that in a normal year doing normal things, I'm somewhere around 20%, right? Cool. And that might be what I use for my projection in looking at what am I going to do this year if I keep doing what I was doing last year or, for the past 5. And so we can extrapolate a little bit based off those numbers and say, okay, my best guess based off the market. And I don't think that things are going to change drastically in the economy or affect my buyers. I think it's going to be a relatively normal year. Okay, cool. Let's go in and look at this. The one case is when you are in an industry that is being affected by things that are happening in the world right now and the kind of macro economy. So we have some wedding planners, for example, or we have some caterers, for example, where things have changed a little bit over the last year. They had things went crazy and bottomed out during COVID because people weren't getting married. Then all of a sudden there's a big old rush after things started clearing up. And it's like, okay, well, now maybe we're settling back down to a bit of a normal thing. However, maybe I'm worried that people aren't going to be getting married and spending as much money on their weddings because of the economy. All right, well, then we might look at that and say, let's compare year over year. How much are people buying and how many people are buying? And so this is what we did with our wedding planner last week. We sat down and we said, let's look at January, February. Actually, we used the last 3 months. It was December through February because we had 3 months worth of data. So we compared that time period in 2022 versus where we were at in 2023. And we looked at a couple things. We looked at, number one, what are the number of buyers? Okay, so we looked at how many sales we had made. It was really interesting. We looked at the number of buyers went up, actually, between the two. And it's like, oh, I'm doing great. I'm saved. I'm fine. And then we looked at the other side of it, which is what total revenue did we have from those? And so we had revenue. And let's just say, for example, that in this case, maybe the total revenue was down. Then you say, well, what do I base this on then? Do I look at the total number of buyers and say, yes, I'm growing? Or do I look at the total revenue and say, no, I'm contracting? And what we found was that we had, maybe in a case where we have more buyers, they might be buying, but at a lower price. So then we have to ask, well, what have I changed in the business? Have I started saying yes to smaller offers, or have I put out smaller offers? Maybe that's the case, right? And so part of this whole projections thing is looking at what's coming down the pipeline. What do I know is happening in my industry? What are the shifts that are being made right now? And how can I adapt to those shifts? And the hard part about business is that you never know. Everyone is looking into a crystal ball all the time, and you can't say with certainty that anything is going to happen exactly as you expect it to. And so we just have to do our best. And so we take these things into account. And if you are in a business that has, let's say you're a single sale and you have a lot of seasonality, but you do know that roughly, if you look at your revenue, some growth rates, then what we can do is say, okay, I'm going to look at last year and I'm going to go January through, I'll look at each month and I'll say all the way through December. So we have all 12 months here, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's messy, but it works. And I say, okay, I know that I was at 30K in January. I know that I was at 35 and then I was at 38. And then we dropped down because it gets slow here. And I was down to 27 and we were still slow and I was at 28. And then I bumped back up to 30 and now we're really starting to rock and we're at 35 and then we're at 42 and on and on and on. And this was 2022. I might make an educated guess and say, based off the factors that I know, I think I'm going to run at a 30% increase this year over last year, just based off what I've been doing historically and what I think's happening in the market. And then I'm going to start making a projection. I'm going to say, okay, what's 30%? If I have a 30% growth rate, what's a 30% growth rate over 30K? Well, that's an extra 10K, so I'm at 40, right? And then an extra 35, that puts me at like 48, let's call it. I don't know what 30% of that is. And so I can make those projections. And then what I can do is I can look at projected versus actual. And I can say, hey, in January, I actually had 42. Okay, we're beating projections a little bit. In February, I was at 49. Okay, I'm great. In, let's say here, for whatever reason, I was at, I projected 52. And then I'm here and I drop down and I'm only at 50. Right? It's like, oh, well, I'm not going to be exactly 30% every single month, right? These projections, no one's projections are exact, right? We will look at the one case where you have a little bit more control over things. But this is a really worthwhile scenario to go through if you're in a business where you really need to plan based off revenue and growth for your team. And so this is something we've done with a number of people where we start looking at, okay, well, what do we expect to make? And we have to go based off historical data. We can't go based off pie in the sky, like, well, I just think my target is I'm going to grow by 100%. Targets are not the same as projections, right? Targets are looking at what do I want to hit and what is required of me to go hit that. And I can create a hypothesis, a guess, and say, I think if I do these things, I can hit this. Projections they have to look at some history to validate what we think is going to happen in the future, right?